All right, so let's talk about the market trends and how this is going to impact your buying experience. So I want to talk about what we saw last year and how this is translating into this year. So last year, the market was categorized by really three main themes. We had low inventory, low interest rates, and we were in a rising market. So we're always in kind of a low inventory market. I'm sure you've heard that a lot. In this particular part of Massachusetts, Eastern Mass, Boston, Greater Boston, surrounding suburbs, we don't have a ton of land. We're a little bit more dense. We have high demand to be here because of our hospitals, our schools, our diversified economy. And so we're always going to have a little bit more lower inventory, especially on a national scale. This was further exacerbated the past couple of years and last year as well by COVID-19. So we saw patterns of people not being willing to move and increased demand, particularly in the suburbs where people could get more space or in more residential areas of the city. What further exacerbated this even more was, and we felt this more last year, were building departments of towns and cities being backlogged or not operating as they usually did. So construction was halted. And then our supply chain issues, which is making things take a lot longer and be a lot more expensive. So what's happening this year? Well, we're still in a low inventory environment. And although construction is picking up, we're still seeing supply chain crunch. And Massachusetts in particular, they are doing things to address the supply chain issues, particularly as it relates to shipping. But experts say that we're probably not going to experience that effect, that trickle down effect in housing until next year. So consider it the same type of inventory environment, low and further exacerbated by what's going on right now. So last year we were in a low interest rate environment. People were still getting rates in the low threes, some of them under, very high twos, those lucky people. I know I didn't refinance in time to get that, but people were getting those interest rates. And now, as everyone knows, and as someone said before, we're in a rising rate environment. The feds have decided to, acknowledge inflation, which has been, going on for a while. I mean, they threatened raising rates for a long time, but they're finally putting their money where their mouth is. So rates have gone up once this year, and they have fluctuated by the market as well. So according to different headline news and speculation in the market, they are supposed to raise the rates again at least another 3 times this year. So we're in a rising rate environment versus last year where we're in a low interest rate environment. Now, experts are saying that they don't expect rates to go really much over 4. So these are still historically low interest rates. So I wish I could tell you, hey, rates are rising, prices are going down. That is not the case, my friends. I'm so sorry. So prices are probably going to, we'll talk about it a little bit when we talk about a rising market, stabilize or continue to increase at a pretty good clip. The reason for that is we're still in a historically low interest rate environment. We're not in the double digits for interest rates for it truly to have a huge effect. It will probably have a more slower effect over the course of time. So what that means for you as you're buying is that you need to get in with a really good loan officer, lender, right from the start. You need to have communication with them as you go, because interest rates might be someplace on Friday. We submit an offer on Saturday, and on Monday, we have a different rate when your offer is accepted. So it's very important to be in communication with that person and to be prepared for any rate increase to make sure that it doesn't really impact your monthly payment in a way where you can't no longer afford the home. So last year, they mentioned we were in a rising market. And what that means is that the market was moving faster than the data. So in real estate, when we look at past sales to predict future sales, the data is usually about anywhere from 1 to 3 months behind, because once you get an offer accepted, that purchase price is not public until the sale has gone through, which can take anywhere from 1 month or 2 months, or if you have a delayed closing, it can be even longer than that. So what was happening is that you'd see a listing and new to the market and you'd think, okay, how did they even get to that price based on the comparable sales? And then it would go 100,000 over asking on top of that. So it's really important that you're working with someone who's an active participant in the market and was understanding what was going on, and what some of the general trends are. So what are we seeing last year for this? Well, jury's still out, but it's looking like it's a rising market, particularly in some of those more residential areas of the city and suburban markets where there is less people moving and more people wanting to move there. So we are starting to see a little bit of a stabilization in some of the very densely urban areas. So think high rise, downtown Boston, type of a feel. And it's not going to necessarily feel like a bargain to you. You're still buying a studio for $1 million, but it's starting to stabilize and become more predictable. Whereas in the more residential areas, the buyers, we're making the market as we're in it. So it's a little bit less predictable.